Just a reminder that this meeting is being recorded, and if anyone wants to sign up for public comment, do so by signing up via the chat feature. All yours, John.
Okay, great. Thank you very much. What I'll do is really quickly, we'll go through, as we all know, the chairman is on a needed break. So they have me taking over today, and it's been a while since I've done any of this. So we're going to try to move through quickly. We have a couple of things that people need to get to, and I'd like to get through the votes early on so that we can spend time on the investment performance and some of the things that are been going on there, just so we always keep an eye on what we're doing on that side of it. Looking forward to hearing from NEPC. Welcome, everyone. Thank you for making the time. I'd like to have Pam go through the roll call.
Sure thing. Do you want to we just want to acknowledge the opening statement, the reaffirmation of the trustees. It's on the screen for everyone to see. We've had it up for a few minutes.
Okay.
That's
great.
It's up. It just wanted to acknowledge that. So I'm going to start with the roll.
Okay, thank you.
Now, Evelyn is out today. So Bal?
Here.
Hyla? Here. I know he's here. Leonard is here. Do you have any audio yet, David? Yes.
Not yet. Yes, I'm here.
And Rush?
Here.
We
Yeah,
have
good.
a quorum. On to the minutes now, John, if you want.
Great. There's the minutes from September 20th, 2022. Does anybody have any comments or any changes or any issues with them? Or can we make a motion to approve them?
So moved.
Second.
Rush.
favor.
Here we go. All right, I'm going to call you last names. Bal?
Yes.
Hyler?
Yes.
Leonard?
Yes.
And Rush.
Yes.
So moved.
Great.
Next slide.
Well, what I'd like to do now is, if we can, is go through the votes. I think they're pretty straightforward. Ellen, if you want to walk through them, and then we'll, is it okay, Pam, if we do A, B, and C together, or would you like them individually, Ellen and Pam?
That's fine with me, as long as I'll just ask a question before we run through the votes. So is everyone, they're written out for everyone to look at. So yes, I'll do that.
All right, so what I can do, Ellen, is if you want, I could read through them so we make it a public record. And then if anybody has any questions or any discussions, we should do that. Or would we rather start off the other way? And Ellen, have you explain the votes, and then I just read through it.
Why don't I do a quick explanation of them? Evan's here because the B is a little more interesting or complex for additional questions. So votes A and C are just to keep on as contractors. Our employee agreements to former employees. In the first instance, Natasha Fee, who left the library a couple of months ago. She will help us out through the end of the fiscal calendar year, excuse me. We have a 6-person office up there. They've been down to 3 or 4 staff, but we have an offer out to 1 person that'll bring us to 5, and we're posted on the 6th. So we really see this as just to get us across the hurdle of being fully staffed up there. The C is Kurt Mansberger, who you may recall was our CTO. Kurt's helping us off and on with special projects. Recently, he helped us with resolve an old E-rate finding that would have cost us a few $100,000, and that's been resolved in our favor. He also helped with long-term lending. And right now we are down our web services manager, so he pitches in with some of the more complex matters there. The middle one is the vote to approve a contract. And I'm sorry, I should watch. Any questions on the employee agreement / contracts?
It would be A and C.
That's A and C. Right.
Yeah. Would anybody have any questions?
And B is the educational fellowship program with Digital Commonwealth to be funded by MBLC funding. That's the Mass Board of Library Commissioners funding, which we receive significant resources from. And this would be to create a educational fellowship to help put more attention to and outreach of the Digital Commonwealth collections. That person would work for Digital Commonwealth, but would engage with our staff led by Evan English. And I'll defer to Evan on it for any questions or additional information. So if there are no questions, I guess we can take the vote, John.
Great. Voted that the trustees of Finance and Audit Committee of the Public Library of the City of Boston vote to approve 2 but not exceed $20,000.00 for Natasha Fee, 77 Danforth Street, Portland, Maine, for communications assistance. Can I get a vote on that? Might as well just do them separately.
Okay, if you want to, that's great.
Yep.
So moved.
Second. All in favor? All right.
Pam, do you
Pam,
need to? roll?
John, do you want me to do the roll call for them? I can't do it when we're on Zoom. I have to do it individually.
Okay, so why don't we just get
If you
through
want
all
to do it
three?
as a slate, why don't you read all three
Yeah, let's just
contracts and then I'll
yeah.
just,
Yeah, let's do it that way. Okay, I forgot about that on Zoom.
that's okay.
On B, item B, vote to approve contract with Digital Commonwealth for Educational Fellowship Program. Voted that the trustees, finance and audit committee of the Public Library of the City of Boston approve a contract not to exceed $90,000.00 with Digital Commonwealth to create an educational fellowship program to conduct a range of activities to increase educational engagement with digital collections, pending approval of a grant from the Massachusetts Board of Library Commissioners. C, a vote to approve employee contract extension with Kurt Mansberger. Voted that the trustees and finance and audit committee of the Public Library of the City of Boston approve an employee agreement extension with Kurt Mansberger of 86 Lake Attitash Road, Amesbury, Mass, not to exceed $30,000.00 to cover technical responsibilities of the web service manager and other projects as needed. So what I would like to do now, Pam, is have this put up for vote for approve A, B, and C as so written.
All right.
Could I get a motion?
Motion, so moved.
Second. It's got to be
Second.
someone else out there. Thank you.
Second here. Here we go.
All right, and this is a vote for all of them with, does anyone have any conflict with any of them? No, okay.
Hey,
So this is a
Pam.
vote to approve all of them.
Pam, just
So-
Jeff Hawkins is here. I joined a little bit late.
Yes, I saw
Hey,
that.
Jeff.
Yep,
How are you?
good. Ball,
Yes.
Tyler,
Yes.
Hawkins,
Yes.
Leonard,
Yes.
and Rush.
Yes.
And I just want to acknowledge that as soon as we started talking, trustee Hawkins joined. So just for the record, I just want to let everyone know that.
That's wonderful.
Next slide, Jay.
So this is our final vote for today, but it's I think this is a little bit more detailed for $200,000. So pretty good size delegation of approval for newspaper image processing project. So if you want to give us a little background,
This is
or Eben, if he's around.
The RFP is due on November 28th, so we don't think we'd have it ready to go in front of full trustees. So we're looking for a little bit of flexibility. It's easier to pull this board together so we could come back in December. As you may recall, we had a partnership with MyHeritage. We gave them hundreds of new microfiche reels, and they've turned that into images we can use, but I'll defer to Eben. They need a little bit more work before we can put them up to the public. And so I'd ask Eben to just fill the trustees in a little bit on that.
Right. Thank you, Ellen. Yeah, so essentially what you said is correct. So MyHeritage, which is an online genealogy platform, we had a partnership with them about 4 or 5 years ago. We gave them access to a lot of our microfilm, and they gave us their digital images that they had created from the microfilm. So in order for us to make those available in kind of like a searchable way, we have to do a little bit more processing to those images. We need to do like optical character recognition, and there's some other kind of structural things that we have to do to organize them in order to be ingested into our repository and make them available on digitalcommonwealth.org. So this $200,000 project would be to hire a vendor to perform that processing, and it would result in us basically getting about 600 to 700,000 pages of historical newspaper content, making that ready to ingest. So it's a big project, but it's a lot of content that we would be getting as part of this contract.
So Eben, can I ask you a question? Because I do go back and go do my own. I use a lot of older newspapers for certain things that I do. Is it simpler now searching? Is it similar to like a Google search? So if someone comes to our collection, or is it easier than that? Like it's more trying to find the dates or times. Is there a certain thing, or is it standard kind of the way research or look at this 600,000 to 700,000, images? Is there a better system than what used to be around?
Yeah, we're actually looking to build our own newspaper content system that would allow for easier searching, like
Okay.
just Google keyword searching, as well as the kind of browsing features that you would sort of be able to look for a specific title from a specific town and browse by date and issue and things like that. So we're trying to make it as simple as we can. In addition to integrating it into Digital Commonwealth, which has access to all the other digital special collections that we've been working on. So it'll be available in both places. And yeah, keyword searching and browsing by title or date, location.
Well, that's great. All right, good. Thank you.
Mhm.
Are there any more comments or questions for Evan or Ellen on this project? It sounds really fascinating. It sounds like it's going to be amazing to have that kind of newspaper backup like that you can easily get with your fingertips. That's wonderful. Yeah, that's great. So anybody have anything else?
Just a quick follow-up question, Evan. This is really fascinating. You mentioned there was an original engagement that we had with a group, I didn't recognize the name.
My Heritage.
My Heritage. Was that also a paid engagement with them, or sort of what was that arrangement? Just curious.
No, it was not paid. It was basically a kind of like a quid pro quo kind of engagement where we gave them access to the microfilm. They scanned it, and then
Got
they
it.
gave us the digital images. They gave us our microfilm back, just to be clear. They didn't keep it. It was we loaned them the microfilm. They made digital images. They returned it to us, and they gave us a copy of those images.
My Heritage is one of the big genealogy companies on the internet, so it allowed for no cost to us to get this information out more widely.
Very exciting.
That's great. Great. Then if I can go through this and get an approval for this, that would be great. So I'd like to put this up for vote right now. That the trustees of Finance and Audit Committee of the Public Library of the City of Boston recommend that the Board of Trustees delegate the award of contract for the newspaper image processing project not to exceed $200,000.00 to the Finance and Audit Committee. This contract is to provide public access and long-term preservation of digitized newspapers and will be funded with the Library for the Commonwealth funding. If I can get a motion to approve
So
this.
moved. So moved.
Second, all in favor?
Sorry, I'll run through the names. Ball,
That's
Yes.
right. Thank you.
Tyler,
Yes.
Hawkins,
Yes.
Leonard,
Yes.
Rush.
Yes.
So moved.
Great. Thank you, everyone. So now moving on to item number 5, the BPL, Boston Public Library Performance and Market Update.
Oh, John, we
John,
did
John,
have
just
one
one
thing
thing.
from Beth on special collections. We're just looking for a little guidance.
Okay. So number 4, okay, I apologize. Discussion of research collection RFP. Beth and Ellen, I guess.
Ellen, do you want me to start this one?
That would be great. Thank you, Beth.
Okay, sure. So this is an RFP that's currently out for vendor responses. This is a large collection move. It is predicated by the fact that a lot of collections needed research collections, not within special collections, but collections that are part of our non-circulating research collections have been moved over time for multiple construction needs. In particular, a lot of these collections were moved off-site due to the rare books renovation because of ducting and other mechanical systems that needed to go through the stacks. These have been moved to a variety of locations. Some are at our off-site storage facility, Koback in West Roxbury. Some are at vendor locations, some are palletized, some are on shelves. These collections have not been accessible while construction was underway, but we are now prepared to bring them back. This is for city capital funding. We don't yet have a selected vendor because the bids are due tomorrow. And so we are asking for a delegation of approval when those bids come in and we have a selected vendor, that it would then go to the full trustees for approval, which we would expect to be at the next trustees meeting. Ellen, is there anything else that needs to be added?
No, I think our question was, if it comes in over 200,000 and the timing works, would it be all right to go directly to the full board rather than vetting it through this committee? I think there's some question as to 100,000 and under, obviously is under your purview. Over 100,000, we either need to delegate it back to you and vote to delegate it back, or we would go to full trustees. So I think we have a little bit of a little uncertainty as to what the cost of this thing is going to be. Is that correct, Beth?
Mhm.
So if it comes in and we don't have time for if the bids are coming in soon, but if by the time we do the evaluation, if it works, would you prefer that we schedule an emergency meeting to put it in front of you if it's over $100,000, or should we just go right to full trustees?
Well, I guess, it's all dependent upon the size. It's I think within reason would be a proper term. But what within reason does that mean? And with the way bids and things are being done right now, and the volatility of even bids on every project out there, I understand. And it's also a need, and there's this a speed to this that we have to get done. I toss it up to other members of the committee. What do we want to do here? I'm okay with it if it's over to move toward the full board vote, because I do think you've been vetting this for a while and I think we understand it. I guess I'm trying to say within reason, and I'm not really sure what that reason would be. 100,000, 50, 150,000. I'm not really sure on that. So if anybody has any comments, that would be great.
I guess if it's maybe, John, what you're getting at, if it's far in excess of what we were anticipating, then it feels like there would need to be a discussion here. Is that it's easier to have a discussion at the finance and audit committee level? Is that, Ellen?
Yeah, that's kind of
and we can pull you folks
where
together
I'm
pretty
coming from.
quickly on Zoom.
Okay, I would say if it's something that's, the rest of the committee members, please feel free, but I think if it's within, I think Ellen and Beth, you guys know what I mean by within reason, and that just if we're over and all of a sudden it's 50% or 70% more, I think I'd be challenged to bring it up to the committee without knowing why it increased so much from where we were originally talking about it. So that's kind of where I'm coming from, and I don't want to slow you down. And if we can do a quick Zoom, if it's a real lot, I recommend doing that then.
Okay.
I don't know if anybody else.
There are multiple legal routes for approval here. I think we will use our best judgment. And the purpose of today's discussion was really so that you all are not surprised if it ends up coming to the full board instead of going back through the Finance and Audit Committee. Although we have the option to either to wait if it's not a long wait, or to schedule an emergency meeting if that feels more appropriate.
No, I agree. And anybody that's done any bidding on any project anywhere right now knows how volatile bidding processes are. So again, David, I will take that and say, look, we've got everything and all rational and reason for why we can approve this. And if it's a really large amount, we can all jump on a quick Zoom call to go through it and make sure we're all comfortable taking it to the full board. And hopefully it's in a range where you don't feel you have to do that and we go straight to the board.
Great, thank you.
Great. Anybody have anything else they want to add? All right. Well, good luck, Beth, with that and getting that in. Finally, one of the things on the item number 5 is the BPL performance and market update. As we all know, the markets have been very different than what we've been used to for the last 10, 15 years. So it'll be interesting to hear from NEPC and Sebastian and team on how the portfolio is doing and some of the things we should pay attention to here. So with that, Sebastian, I'd love to hand that off to you.
Thank you, and good morning, everyone. It's good seeing everyone again. Pamela, would you like me to share my screen, or would you like to run with the presentation that we sent to you?
We have the presentation if that's all set, because it's our IT person has it. I don't have control of it.
Perfect. Okay, this is exactly what I wanted just to make sure that we had. Thank you so much. So as John mentioned, it's been quite an interesting ride this year. I think the last time we met, we were coming off of a pretty banner year in 2021. We saw markets really rebound off of the impacts of COVID. And we saw significant rally across the board, risk assets, non-risk assets, really a banner year in 2021. Fast forward through the first 9 months of this year, and really what you're seeing is a very sharp reversal of that. And we can keep it right on this page here, as I think this will give you a good snapshot of what's happened over the last 9 months, and what we view is likely to continue to be the case, at least for the foreseeable future. One of the dynamics that we've seen this year is that we've seen a very sharp and high correlation between both equities and fixed income. And this is a relationship that historically has seen slightly negative correlation to one another, meaning that when equities are performing well, fixed income is typically pulling back a bit. And then when the vice versa is happening, when equities are selling off, you see fixed income performing well as investors shift to more of a risk-off posture. The combination of higher inflation and the resulting moves by the Fed this year is really throwing that dynamic out the window. And really what you're seeing is that, particularly if you're looking at the calendar year-to-date column here, both equities and fixed income have sold off. And that produces a very challenging environment for investors, because really what that means is that there's really no place to hide. And even as a diversified investor, we're impacted by that. When we look across the portfolio, as you will see here, the composite is down about 21% on a calendar year-to-date basis, which is ahead of the benchmark, the 60-40 that we use. This is a benchmark that's traditionally been thought of as sort of this institutional portfolio. We'll talk about it in the market section here in a moment, but this return that this 60-40 benchmark has achieved this year is one of the worst returns for that benchmark historically. So if you look all the way back to 1936, it's the second largest sell-off on record that we have, and equates to approximately $9 trillion in investor losses year to date. What that tells us is today we're sitting right in the midst of a bear market, meaning that there is a bit of a risk-off sentiment. And as we look forward, one of the things we want to think through is, given the sell-off, typically we would think about how and when do we want to start to think about rebalancing. And we don't think we're just there yet. Part of the reason for that is we don't think the Fed is done increasing rates. I think tomorrow we should be hearing of another 75 basis point increase, and there's a likelihood of one more before the year ends. And one of the key data points that we're looking at as we look into 2023 is, where do peak rates settle out? And what that means is, where does the Fed stop to reassess and review how the work that they've done over the last year and a half has actually stunted or impacted inflation and potentially brought that down. So when we go through the materials here in a moment, what you'll see is that there's this belief, both by the market and the Fed governors. We have a Fed dot plot in the materials that really show you that through mid-year next year, there's an expectation that we'll still continue to see that rise before that levels off and starts to decline, as the view is at that point, we'll start to see inflationary pressures decrease, and the work that has been done start to impact some of those pressures along the way. When we look across the portfolio, as I did mention, you do see some returns that do stand off the page. I think I'll mention a couple of things here from a strategic perspective. So when we think about how the asset allocation of the portfolio is positioned, about 60% of the portfolio is in equities. That's across the US, non-US, and global equities. About 30% of the portfolio is in fixed income, and there we balance out higher quality. So think treasuries, very high quality corporate debt, with more yield-seeking assets. And then we have a diversifier in this balanced allocation at the bottom in the PIMCO All Asset. Today, we're exactly on target when it comes to our equity allocation. So we have a 60% target to equities. The allocation amounts to about 60% as well, with a tilt towards the US. And that's a favorable position for us because we'll talk about what's happening in Europe and beyond. There are some significant headwinds to growth in those markets currently because of the macro conditions that have occurred, namely the Russia invasion of Ukraine and the impact that's had on energy prices. And as we look towards China and emerging markets, they've slowed a bit in growth throughout the year. And one of the things that we'll be looking at on a go-forward basis is how the zero COVID policies impact potential supply chain and the broader global economy as a result. On the fixed income side, what we're seeing is obviously rates are increasing and particularly on the shorter end of the curve. So what we want to have is a little bit of balance there. So even though you do see some negative results here, one of the positives that comes out of this type of environment is as the managers are reinvesting, they're investing at higher rates. And not for today's meeting, but for a future meeting, one of the things we do want to bring to the attention of the group is really taking a look at potentially adding a shorter duration credit manager where the yields today are in the neighborhood of around 9 or 10%, given what we're seeing on the shorter end of the curve. And this is more of a trade-off play, meaning that we do still see some headwinds for equities. And if we're looking at a risk premium trade-off, we think that credit may be much more attractive today relative to equities. So something to consider the next time we speak. And then the last piece here is that the PIMCO All Asset, as I mentioned, they're down about 17%. You know, this is a very broad-based diversified strategy. Really focused on a lot of different asset classes. However, these asset classes do tend to be a bit growth oriented, and as a result, you're seeing that pullback. So while on an absolute basis, the return is negative for the year, on a relative basis, you'll see that the managers have been able to protect on the whole. So compared to the benchmarks, we've outperformed. And as we look at the allocation, there is no recommendation for rebalancing at the moment, but it is something that we will more than likely come back to you at the next meeting to at the very least discuss potentially making some adjustments to the portfolio.
Yeah, and Sebastian, could you take a moment just to explain when you make those moves and you have, you know, losses in a portfolio, you know, being patient or trying to understand how much you can ride out. The old adage, you know, that people sell at the worst times and
That's
buy
right.
yeah. So you don't want to miss coming back. But I think this is your debate is how long are we in this challenging period? Does it last a short period of time, or does it go on for the next few years? And no one's, of course, sure of that. So I guess what I'd love for you to just take a minute, because you don't want to miss those big trading days when the market does come back. And how do you prepare a portfolio like that so you don't get out of the market too early or too you don't take advantage of it coming back?
Sure. I think maybe if we move over to page 7, I think this will be a helpful slide for us to. Oh, it would be in the other presentation. Sorry. So it's titled this. Yep, this slide right here. So John, you're absolutely right. I mean, one of the things that we have to always contend with is emotionally when you see the sell-offs happening as they do, you know, your instinct gut reaction is that we should become more conservative, and perhaps it's something where, you know, let's pull back and wait for the market to settle and then get back in. But from an discipline perspective and from being a long-term investor, one of the things that ends up happening in those types of situations is that if you look at it historically, if you're out of the market on the 10 best days of the market returns, that has a significant impact on your actual return on a trailing from a trailing perspective. So we want to be disciplined in maintaining market exposure, even in times and bouts of volatility such as this, because you will have periods when the market bounces back and you want to be fully invested in those times so you can reap the benefits of this. I think a perfect example here on this page, and there are a lot of lines on this page. The light blue line is our current market sell-off, the current bear market that we're going through. And even within this market, what you're seeing is that there have been periods where the market has bounced back and still come back down afterwards. And this is to my point that one of the reasons we're not fully recommending clients rebalance, get back to targets, et cetera, is because we think that there still may be another leg down to this. So what we're looking for is seeing as we move forward, you know, what is the guidance we're getting from the Fed? Is the action that's happening on their end really having an impact on inflation? And we know not everything they do has an instant impact. There's some delayed numbers that come through. So as we look forward, things like housing and shelter, you know, there is an expectation that we'll see that reduce over time, and then that'll naturally bring the level of inflation down as well. But this is one of the things that we're looking at, because as you can see, every bear market historically has been different. And if you look at the far left here with the 2020 heading, you know, that was a very sharp, steep, and quick sell-off. And it took us about 5 months to come back in 2020. And we had about 1.5 years of a significant run before we were in the current situation that we see now. On the flip side, if you look to the far right, the dot-com bubble, the 2000 through 2002, that was a very prolonged bear market. It took a little while for us to get through that and come out on the other side. So it's difficult for us to say, you know, whether we're going to see something like that or see something closer to what we saw in the 70s, which is this more entrenched inflationary type environment, higher rate environment that we saw in the 70s, which we think is probably closest to what we're seeing today. The duration is the question. So when we think about rebalancing, when we think about making shifts, raising capital, pulling money from areas that are down, unless we have to, we want to be mindful of not selling when we're down about 20% from any part of our portfolio. But we also want to be mindful of opportunities that are there, right? So if we're thinking about the trade-offs that we're seeing in equity markets, and for example, believe that there still is another leg to drop, and we see an opportunity to hedge that a bit by moving a portion of the portfolio, understanding we are selling in a volatile market. You know, that type of a trade-off, perhaps it's dollar cost averaged, or we look at it in a different structure, is something that may be worthwhile, because at the end of the day, that should actually represent a net positive in terms of performance because of those moves. The one thing that we don't want to call yet, as I mentioned, is that when we look at this chart specifically and then compare it to slide 11, we really want to see that there is some stability and some clarity from the Fed around what the next steps are. And when you look at this chart, I mentioned peak rates. So peak rates at the moment are seen as anywhere from 4.5% to 5% and happening at some point in 2023, meaning that the Fed will hit a certain level of rates and pause to see how they've actually, how they've done in terms of their goals. If we do see that clarity that the Fed has hit peak rates, it's likely that these two lines here have converged, meaning that inflation and rates are now closer to one another. And that provides real clarity on a go-forward basis that at the very least, the Fed has paused, and the likelihood of further tightening is perhaps not as high as it is today. And that provides some clarity around, perhaps now is the time to start to leg back into some of these areas that have sold off. So that was a very, very long-winded answer. Apologies for that, John. It's just it's a question that doesn't have a simple one, I don't think.
Sebastian, good morning. You mentioned the possibility of adding a short-term credit manager, which would obviously involve moving, therefore selling some of the portfolio to invest in that area. Could you talk a little bit about that and what the holdings might be, as well as how to gauge timing, given that we don't move very agilely. We really are more about the long-term policy and a more conservative approach. So I appreciate the input, but also wouldn't want to be in a position where we miss the right window to make that kind of shift aligned with our long-term policy concerns.
Sure, no, absolutely. And it's a fantastic question. And I think this is one where if we continue to see some of the frothiness and the volatility that we've seen, the premia that we expect, and if you go to slide 13, you'll see a little bit of this, the premia that we expect from equities versus credit starts to favor credit a little bit more. especially if we see continued sell-off or pressure on the equity markets. So from a timing perspective, I don't think we lose anything if we wait a couple of months to actually to pursue that, particularly if we know that the Fed has at least another 75, if not 1.5% of rate move to go, because that makes that shorter end of the curve continue to be a bit more attractive from an investment perspective. So here, you know, this is a little bit of a longer term play, but if we were to look at this historically, and even going back to 2008 when spreads widened out significantly, the timing is important because you want to get in at a good time. But I don't think we're in such a place that premia shifts and reverts back in such a sharp way that we miss anything. And I think that's the key thing here. The holdings, there aren't too many managers in the short duration credit space. I will say that. So when we're thinking about the universe, you know, there's a way to play it passively, but you do give up some yield, and there's a way to play it actively. And there are a very small subset of managers that play in that space. It's a very unique approach that the managers that are in there do take. It's a little bit of bank loans. It's a little bit of buying securities that are about to sunset. So you're not taking that duration risk. But it's something that really is attractive from a yield perspective and worthwhile, I think, discussing.
So without putting words in your mouth, that sounds like you were asking us to consider that in more detail at one of the next meetings, at least to become more educated about what the opportunity might be, if not actually to move towards a decision.
Correct.
Yeah, it's David, it's really just saying you want a reevaluation of the portfolio, where it's going. I think historically, you've never seen the 60-40 ever perform this badly. As Sebastian was saying, 1936, I think, was when they started tracking this. This was the worst bond market in the history of bonds. You go back as far as you possibly can, worse than 94. So it's been fascinating to watch this occur, the correlation that happen in the markets. And I guess the question is, you know, do you make, and Sebastian, this is probably going to be the challenge, is do you make a move now, or do you ride through it for the next couple of years, unless you really feel that we could be in this challenge for longer than a year, or longer than a year and a half, or going out a couple of years. And again, it's a long-term portfolio, but David's right. The liquidity and the protection of the principal of this is really critical and paramount. But at the same time, it's not losing money by jumping too soon. That's all.
That's exactly right. And I think if you are looking at it from our perspective today, we prefer to err on being a bit more conservative for now. There are a number of things that are still out on the horizon. You know, obviously we have elections coming up here. Market doesn't like uncertainty, so we want to get through those. We talked about the Fed and global central banks and what they're doing. Clearly, we're not the only one that's raising. If you look to Europe and the UK and more globally, you're seeing that happen as well. So we have to get through that cycle. And Europe in particular is unique in that their inflation is largely driven by what's happened in the energy markets. And in certain countries, it's significantly higher than what we're seeing in the US. You know, we're talking double digits, if not mid or high teens in certain instances. Energy is a huge input to manufacturing in Europe and really globally. So to the extent that stays high and the continent is not able to gain access or replenish what they're using, that could put significant pressures on growth, at least for the foreseeable future in Europe. So that's something that we want to look at as well. I mentioned the situation in China. So globally, there are definitely things that provide us some pause as to simply saying it's time to kind of get back to where we were. So we prefer to err on the side of caution, at the least for the time being. But within that, we also don't want to just rest on the laurels and say, you know what we have in the portfolio is perfect, and we don't need to think about ways to improve returns on the margins. Which is why when we think about opportunities or trade-offs, today, the trade-off of equity to credit seems like an attractive one, and it's not a situation where if we wait 2 or 3 months that goes away. I think it's just as compelling when we talk about it a little bit down the line here and think about it from that perspective.
Great.
Just one more question. Where in the portfolio is there international dimension, either in terms of exposure or opportunity?
So the biggest
Yeah,
exposure.
and Sebastian, the follow-up to that would be how, to David's question, would be the decoupling kind of that's going on globalization. Is this really going to be a long-term trend, or do we see it just as a hiccup between the global powers, and or is this a trend that we need to pay attention to? And the balance of U.S. equities versus international is kind of the big question out there right now.
It is, and it's one that we've been talking through for quite a bit of time, because I mean, you're right. It's what you're seeing is a real, because decoupling is the right term, where you're seeing the U.S. really stand out in terms of global equity markets as being sort of, you know, I guess the safest, and I'm saying this with quotations, of the bunch. You know, one of the things that we've looked at from a strategic perspective is when we think about global equities, we look at it from an MSCI ACWI perspective, right? So that's sort of the S&P of the globe, and look at where the regional weights and exposures are, and try to think about it in that way when we're building our exposure. Today, we're definitely more focused on overweighting US versus particularly developed non-US. And a little bit market or slightly above on emerging markets. Simply just from a growth perspective, we do believe in the growth, in the long-term growth prospects there. That's not to say you want to move fully away from a non-US equity. I think from a diversification play, if you're looking at what sectors, industries, et cetera, have historically produced there, they're a bit different than what we have in the US. So there is that diversification lever. And I think the one thing that we have to contend with today is just the stronger dollar. Obviously impacts the returns that we're seeing from those markets. One of the things that we'll be looking at as we move forward is sort of that carry trade, right, between the US dollar and US rates and what you're seeing across seas. And that's basically the differential in the yields that you're earning on similar debt. As I mentioned earlier, if we see, you know, the European Central Bank continue to move, I mean, they did make an initial rate increase earlier this year. And as long as we continue to see them go down that path, that starts to make things closer to parity. So the demand for certain things like, you know, US rates or US dollars starts to dissipate a bit. And that should hopefully level things out over the long term. In the near term, there are some pressures there that we have to contend with. So I don't think it's necessarily a situation where we want to reduce strategically the allocation to international. And we have one allocation with Earnest Partners. They're a core international equity manager. When you look at their results, all else being equal, they've actually performed quite well and more or less in line with what we've been seeing in the US large cap space. So their stock selection has really driven a lot of the performance that we're seeing here. But I think on the whole, just from a macro perspective, with everything that's happening, you know, there may be some greater pressures overseas than in the US today.
Great. Anybody have any other questions for Sebastian? All right, great. So I guess just ending on page 15 is kind of what you're looking at to just position the portfolio and just maintain where we are, but looking at this equity to credit trade right now, and that's kind of the big decision you guys are going to look at to recommend to us, correct?
That's exactly right. I mean, I think if we're looking at the trade-offs, we know that inflation is entrenched for the moment. It's in more of the, obviously energy and food have seen it as well, but it's coming through in the core parts of CPI. So we're looking at ways to play that within the portfolio that generally tends to favor value over growth in this type of environment. Just more cyclical names that the managers can access there. We do have exposure there through Diamond Hill and through Siegel Bryant. We still want to maintain adequate liquidity, which is why you don't see any kind of move in the fixed income portfolio from the current makeup, because we think we have the right balance there if we do need to raise capital for spending, et cetera. And then the last piece here, it's starting to look at and legging into short credit. And we do have a number of, I think here I mentioned equity as a trade-off. We do have a number of levers we can pull as a funding source for this, because I think the PIMCO All Asset, it is a very diversified fund, but it could be used as a source here as well. So there are a number of ways that if we do pursue this, we can look to fund it.
Great. Does anybody have anything else they'd like to ask? All right, with that, I don't think there's anything we need to do other than just listen and pay attention to the market. So thank you, Sebastian. Appreciate it, as always.
Thank you.
All right, so what I'd like to do now is move on and follow up on that with any new business. Does anybody have any new business on the agenda? And this goes out to David or anybody.
All set.
All right, great. If not, I'd love to jump into public comment. Pam, did we have anybody sign up?
Today's your lucky day, no public comment.
Okay, well, great. Thank you again, everyone, for making the time. And I will tell you, I think paying attention to the portfolio is really important. My dogs just came in the house, so I apologize for the growling in the background. Anyhow, I just think paying attention to the investment portfolio, letting them do their job, it's just patience is going to be a virtue here on timing, and I like the way they're approaching that. It's a really important aspect to the library and its sustainability. So I think they've done a pretty admirable job in a pretty challenging market environment. But I think staying on top of this is going to be really important. With that, I don't have anything else. So I guess I'd like a motion to adjourn.
So moved.
Moved.
Second. All right. So adjourned. Thank you, everyone. Bye-bye.
Thank
you all.